Hello, everybody. Welcome to this episode of the Investor's Wisdom Nugget. Today, I'm going to be talking about a completely new area, an area which I have not talked about. I'm going to be talking about trading foreign currencies online. Is it a good idea? Is it a bad idea? I think this is a situational decision which a person can actually make on their own after considering the pros and cons of trading foreign currencies. But I'm just here to highlight some very important information which every beginner trader should actually acquaint themselves with. You need to understand first and foremost, the structure of the international forex market. Well, at least we are told the international forex market is open 24/7. That market is not like a global market which is always open and trading at the same level each and every time of the day. No, the international forex market is actually made up of subsets of markets which are conjoined to make a 24-hour trading day. The international forex market is the Asian market, which is basically Tokyo, New Zealand, Australia. It also have the London stock market, the London market, which will usually take over from the Asian market in terms of time zones. And that market will also pass it on to the North American market, which comprises of Canada and the United States of America, New York. So it is very important that as a trader, one needs to have a strategy. And within your strategy, you have to be tactical. When you decide to trade, for example, what is called the cable, US dollar versus the pound, you need to understand the best time to trade that currency. You need to understand when to buy, when to sell. Usually, volatility creates margins, potential for profit, and you must understand at what times of the day is the volatility at its highest levels. Why do forex traders lose money? This market is quite complex because there are so many muscular in terms of their financial size and influence players in that market. And retail traders like myself and yourself, we have no influence at all. We are actually the most vulnerable. It's easiest for all the other players to make money from us. Why do they make money from us? It's very easy to make money from us because most of us, we are easily cheatable, if I may put it that way. International institutional traders, they will always indicate left and turn right. What do I mean? When indications are quite strong that the market is going up on a pair, before it goes up, they will always make sure, because you know it will certainly go up at this point, and you take a position. For example, if it's a buy decision, and what do? You always put what they call stop losses as part of your risk management. When you put your stop loss, this is a very important question that I have always been trying to find an answer to. I have asked myself several questions this question. When I put my stop loss on a trade, who sees it? And what are the interests of those people who see my stop loss? The reality is, when you put your stop loss on your trade, the online broker will actually see your stop loss. So they see your intentions. So when we look at all the other players, retail traders, we are the ones who are quite exposed because we communicate clearly in no uncertain terms our intentions, our thoughts, what we think is going to happen to the market. Sometimes we're even overexcited, and when we put a take profit level. And what do? They will always make sure that they jettison us out of our trades. They will push the price against us. For example, if the pound is trading at 1.3 to the US dollar, and you know it's supposed to move possibly to between 1.5, 1.6, You buy, and after buying, you put your stop loss possibly 1.25. They know, don't think they are stupid, and they are there to make money, and they are there to make money from us, especially the beginners. So they will always cheat us, they will always indicate left and turn right. That's why when you look at the candlesticks, have you seen that there are always spikes most of the time? What are those spikes? Are they real trades there? I want to believe there are no real trades most of the time. And after some serious research, I've realized that most of those spikes, if you put your stop loss, you won't actually be able to cash out of your trade at those levels, because what they will do is they will simply offer very few, possibly make just an offer of very few units of a currency, and when they put that offer, that's good enough for them to take you out of your trade. So I believe stop losses are really one of the reasons why retail traders lose a lot of money, because we make our intentions certain to people who should actually not know our intentions, to our rivals, because remember, they want to make money from us. So when we show them what we think, what we expect, we are exposing ourselves. Risk management, strongly related to the issue of these stop losses, is the idea of risk management. Risk management is one of the reasons which has been cited by many scholars and researchers as to the reason why retail traders lose money. When you try to risk manage, it's really very difficult for you to make money. So my preferred way of doing it is to take a position. I don't put a stop loss, I don't put a profit taking position. I observe my trade and take action accordingly. Number two, the other very important thing that people need to understand is the aspect of indulgence. What do I mean by indulgence? Before you start trading actual currencies, you need to research, you need to study how those markets operate. And when I say research, it's not something that you can do in 2 months, in 3 months, in 4 months, in 6 months. You may even need up to 2 years of studying the markets, how they operate. Run demo accounts. And I want to let you know also that those demo accounts are not necessarily the same as the real platforms. When you go to the real platforms, most traders will be shocked. Why am I now making losses, but I've been making profits on the demo accounts? Those demo accounts are a marketing strategy by the brokers. So they are always meant to make you believe that you are somewhere, you are, or you may put it to say you are there, when you are not really there. So you need to practice. Sometimes I would, for my personal example, I opened 5 demo accounts with different traders, trying various strategies. And that's when I concluded that, 90% of the times, what appears to be certain to be happening in terms of the price movement is not what will actually happen. Because that market is very, very strong, it operates on the strong form of market efficiency. So what do we mean strong form of market efficiency? All the information is captured in those prices. So you cannot use technical analysis and fundamental analysis and consistently outperform that market. So it's not value additive for you to invest lots of resources, especially time, to research, and then you think you identify an undervalued currency and then you buy it. That will not happen, because those market makers, remember, they have to make money under every situation. Those markets will move up and down, they always move sideways. Why are they always moving? And why are they not only moving in one direction? They won't make enough money. So they always market make, create what may seem to be opportunities, potential indicating this way, turning this way. That's how they make money, and that's how they take money from retail traders. So it is quite important for you to understand these things. Another very important thing is when you go to each and every online broker's platform, you always be greeted by this statement: 70 to 80% lose money when trading CDFs. Is that correct? That statement factual? I am tempted not to believe that. Are they talking of the numbers? Are they talking of volumes? And remember, they are not saying 70 to 80% of new traders or beginners lose money. They are just saying of traders. And when they say of traders, they are including all those institutional traders, those market makers. They are part of the 100%. I'm afraid to say, in my view, possibly 98% of new traders lose money. They donate money to those institutions. So you really have to be very architectural when trading Forex. You also need to understand the time of the day that you should be taking your positions. A Forex trader does not sleep. A Forex trader is a 24-hour day. You have to be sniffing for opportunities. You have to be sniffing for opportunities, and you have to be content. Please be content with small gains. Small gains over time will grow your account. Don't be cheated. Don't be fished, let me say, using those margins where they tell you our margin is 1 to 30, our margin is this, what they call leverage. That is also the rate at which you will lose your money. It's very easy to blow your account if you are trading on a very high leverage. So even if you are offered those high leverages as a beginner, don't take them up. Don't utilize them. Try to go slow. Try to go precautiously, because once you lose your capital, it will frustrate you. Once you lose your capital, sometimes you won't be able to rise up again. So it is very important to avoid early frustrations when you are trading Forex. So Forex, while least people can make a living out of it, the reality is that it is quite difficult to earn a living or earn a steady income from foreign currency trading. I don't advise a person to use the money that they have other uses for in the immediate future as investments in foreign currency. It's not really an investment in my view. It's quite speculative. It's quite dangerous. People have to do it with caution. Thank you so much for listening. If you haven't subscribed to my channel, kindly click the subscribe button. If you think this content is valuable, don't hesitate to share with colleagues. Thank you so much. Till we meet again next time. Love you so much. Bye.